On Wednesday afternoon, at exactly 2 o'clock Eastern Time, the Federal Reserve is going to release 18 pages of typed minutes. And somewhere inside those 18 pages is a sentence that could move the price of gold by more than it has moved in the last 3 weeks combined. Most people who own gold or silver have never actually read a set of FOMC minutes. They see the headline on a financial app, they see the price move, and they move on. But the people who take 20 minutes to actually understand what they're looking at, they walk away from Wednesday with information almost nobody else in their circle has. That's what today is about. Before we get into it, let me ask you something. If you own gold or silver, or you're thinking about buying either one, do you actually know what a Fed rate hike does to the price of the metal in your hand? Not the general idea, the actual mechanism. Because by the end of this video, you will. And I think you'll be surprised at how differently it applies to gold than it does to silver. Welcome back. If this is your first time here, this channel exists for one reason: to take the research that actually moves gold and silver and explain it in plain language without the hype and without the noise. Today we're covering two things that are, on the surface, separate stories. But by the end, you'll see they're actually the same story told from two different angles. First, we're going to walk through exactly what's inside the FOMC minutes landing this Wednesday, August 19th, and the 5 specific things worth watching for when they drop. Second, we're going to look at something that a lot of precious metals investors have noticed, but very few have had properly explained to them. Gold and silver hit their all-time highs on the exact same day back in January, and since then, one of them has clawed back most of that ground. The other has barely moved. We're going to unpack why. One quick note before we start, because I think it matters. Everything in this video is based on research pulled together specifically for this video, using the most recent data available at the time of filming. Markets move fast, and by the time you're watching this, some of these numbers may have already shifted. Nothing here is financial advice, and nothing here is a signal telling you to buy or sell anything. This is education. It's meant to help you understand the forces at work in this market, so that when you do make decisions about your own money, you're making them with a clearer picture. Any real decisions should involve a professional who actually knows your personal situation. With that out of the way, let's get into it. Let's start with the basics, because the term FOMC gets thrown around constantly in financial media, and it's rarely explained. FOMC stands for the Federal Open Market Committee. It's the 12-person group inside the Federal Reserve responsible for setting the direction of U.S. monetary policy, including the benchmark interest rate that ripples through everything from mortgage costs to the value of the dollar. This committee meets 8 times a year on a fixed schedule, and at every one of those meetings, it votes on whether to raise interest rates, lower them, or hold steady. Here's the part that matters for what we're covering today. On the day of the meeting, the Fed puts out a short statement announcing what was decided. That statement is maybe a page long. 3 weeks later, something much bigger comes out: the full meeting minutes. These are a detailed account of the actual discussion that happened behind closed doors, what each member argued, where they disagreed, the specific language used to describe inflation, the labor market, and the risks ahead. For anyone trying to understand where interest rates might be headed, the minutes are historically the richest document the Fed puts out each month, and gold tends to react to them more than almost anything else on the calendar. So why does this particular release matter more than a typical one? Because of what happened at the meeting itself. On July 29th, the Federal Reserve, now under Chairman Kevin Warsh, voted to hold the federal funds rate steady at a range of 3.50 to 3.75%. That was meeting number 5 in a row without a change. On the surface, a hold sounds uneventful, but the vote wasn't close to unanimous. It was 9-3. 3 regional Federal Reserve presidents, Beth Hammack of Cleveland, Neil Kashkari of Minneapolis, and Lori Logan of Dallas, all voted against the hold. All 3 wanted an immediate rate hike. According to several analysts covering the meeting, that marked the first time since September of 2016 that 3 FOMC members dissented together in the same direction. That is not a routine outcome. Most Fed votes are close to unanimous. When 3 sitting regional presidents break from the chair on the same side of the argument, it tells you the room was genuinely split, and that it wouldn't take much for a couple more votes to shift the balance toward a hike at the next meeting. Now here's where it gets more interesting, and this is the part I really want you to sit with. Everything that's happened economically since that July 29th vote has been leaning in the opposite direction of what the 3 dissenters wanted. Let me walk you through it. July's Consumer Price Index, released on August 12th, came in at 3.4% on a year-over-year basis, down slightly from June's 3.5%. That's the second straight month the annual inflation rate has cooled, even if only modestly. Then, on August 13th, July's Producer Price Index came in completely flat month over month. Producer prices are what businesses pay before those costs eventually show up in what you and I pay at the store, so a flat reading is generally read as a good sign for the inflation outlook. And then there's the one that really shook people. July's non-farm payrolls report, released on August 7th, showed the U.S. economy lost 23,000 jobs. Economists said expected a gain of around 80,000. Combined with downward revisions to May and June, the labor market picture just went from cooling gently to cooling much faster than anyone modeled. Here's the piece that ties it all together, and it's the piece most casual investors miss entirely. The FOMC minutes releasing on Wednesday reflect the debate as it stood in late July before any of this data existed. The dissenters made their case for a hike using information that, in some ways, has already been partly undercut by what's happened since. So when you read those minutes, you're not just reading history. You're reading the exact argument that this week's data has been quietly working to dismantle, or, depending on what the language says, reinforce. So what should you actually be watching for inside the document? Let me give you 5 things. The first is how the 3 dissenters framed their case. Were they worried mainly about the headline inflation number itself being too high, or were they worried about something more structural, like inflation expectations becoming unanchored, meaning the public starts assuming prices will keep climbing and adjusts its own behavior accordingly, which then makes the inflation self-perpetuating? If it was mostly about the headline number, this week's cooler CPI print has already partially answered their concern. If it was about expectations becoming unanchored, that's a much harder problem for a single soft CPI reading to solve. The second thing to watch is the specific language the majority used to describe what would actually trigger a hike going forward. This is usually buried in 1 or 2 sentences, and it's arguably the single most market-moving passage in the entire document. If the bar described is low, something like continued firmness in inflation data would likely be sufficient. Then this week's data may have already cleared that bar in gold's favor. If the bar is high, requiring sustained evidence across multiple categories over several months, then a September hike stays meaningfully on the table even after a softer CPI print. The third thing is the specific words used to characterize inflation itself. Fading, normalizing, or persistent, entrenched, elevated. After the Fed's very public misstep in 2021 and 2022, when officials repeatedly called inflation transitory and were proven wrong, the word choice inside these minutes tends to be deliberate. Softer language lines up with what the CPI and PPI reports have shown. Harder language suggests the committee wasn't convinced even before this week's data came in. The fourth thing to watch is what, if anything, members said about the labor market before the July jobs report existed. Did any of them flag softening employment based on June's data? If even a minority voice raised concern about the labor market before the actual loss of 23,000 jobs was known, that combination becomes difficult for the committee to wave off heading into September. And the fifth thing, the one least likely to appear but the most powerful if it does, is whether any single member floated the idea of a rate cut before the end of the year, not necessarily arguing for one, just introducing it as something worth modeling. If that shows up anywhere in the text, it would represent a real shift in the framing of where policy is headed, from hike or hold to hold or cut, and markets tend to move on that kind of shift almost immediately. Now, the minutes don't land in a vacuum. There's a full week of data surrounding them. Monday brings July industrial production. Wednesday afternoon is the minutes themselves. Thursday brings the Philadelphia Fed's regional manufacturing survey, along with the latest weekly jobless claims. And Friday closes the week with the preliminary August reading on manufacturing and services activity from S&P Global. Every one of these releases either adds weight to the case for a September hike or takes weight away from it. And based on the CME Group's FedWatch tool, market pricing for a hike has already fallen from around 55% a week ago to somewhere in the 30 to 35% range as of this recording, which tells you the market itself is already leaning toward believing the Fed is done for now. But leaning isn't certainty, and that's exactly why Wednesday's document matters. All right, that's the roadmap for the minutes. But I want to shift gears now because there's a second story running underneath all of this, and once you see it, you won't be able to unsee it. Gold and silver hit their all-time highs on the exact same trading day, January 29th of this year. Gold touched somewhere around $5,600 an ounce. Silver touched somewhere around $121.60 an ounce. Two metals, same day, both at price levels the market had genuinely never seen before. Here's where the story starts to diverge, and I think this is the part almost nobody explains clearly enough. As of this week, gold is trading around $4,373 to $4,400 an ounce, which puts it roughly 21 to 22% below its January peak. Silver is trading around $64.76 to $64.96 an ounce, which puts it nearly 47% below its own peak. Gold has recovered a meaningful chunk of its correction. Silver has barely moved off the bottom of it. But wait, because if you only look at the year-over-year numbers, the story flips. Gold is up somewhere around 30% compared to a year ago. Silver is up closer to 70% over that same stretch. Silver's annual number looks enormous because it started from such a low base last summer. It's when you narrow the lens to just this calendar year, January 1st to today, that the real divergence shows up. Gold is roughly flat to modestly positive year to date. Silver, by contrast, is down close to 9% for the year. And the gold to silver ratio, which tells you how many ounces of silver it takes to buy 1 ounce of gold, currently sits around 67. The long-run historical average is closer to 65. So the ratio isn't wildly out of line with history, but it is telling you plainly that silver has not caught back up. I want you to sit with that for a second, because here's the natural question. If gold and silver were being driven by the exact same forces back in January, why did they separate so sharply once the environment shifted? To answer that, you have to understand why they moved together in the first place. January of this year was a genuinely rare convergence of pressures hitting all at once. Escalating conflict tied to Iran raised real fears of an oil supply disruption. Those fears fed directly into worries about energy-driven inflation, forcing the Fed into a more aggressive hiking path. On top of that, there was deepening concern about the U.S. fiscal picture, with the national debt and the cost of servicing it climbing quickly. And layered over everything was a broad flight toward assets that don't depend on any government's promise to hold their value. In that environment, gold and silver were being bought for the same reason: fear. And fear doesn't discriminate between the two metals, it just wants hard assets, and it buys whatever is available. Then the environment shifted. Oil stabilized somewhat. The dollar found support as rate hike expectations rose through the spring and summer. Real yields, meaning the interest rate you actually earn after subtracting inflation, climbed as the Fed held rates high even while inflation cooled. And once the panic phase passed, the market started asking a much more specific question about each metal individually. Not, should I own precious metals, but why am I holding this particular one right now at this particular price? And the answers turned out to be very different for gold than for silver. Before I go further, I want to pause here, because if you've made it this far, you clearly care about actually understanding this market instead of just chasing headlines. That's exactly who this channel is built for. If that's you, take a second and subscribe, because breakdowns like this one, the ones that connect the dots between a Fed document and the actual price action in your portfolio, are what this channel does every single week. All right, let's keep going, because this is where it gets genuinely interesting. For gold, the case for holding it stayed intact even after the initial fear faded. Central banks kept buying, and not modestly. According to World Gold Council data, central banks added a net 288.9 tons of gold in the second quarter of this year alone, a jump of roughly 62 to 74% compared to the same quarter last year, and the strongest second quarter on record. Poland's central bank led the buying, adding 51 tons and pushing its reserves above 630 tons as it works toward a long-stated 700-ton target. China's central bank added 33 tons, its largest single-quarter addition since late 2023, bringing its official holdings to roughly 2,146 tons. What makes this notable is the timing. Central banks were buying aggressively during a quarter when gold's price actually fell by double digits. That's not how a typical trader behaves. That's how a long-term reserve manager behaves, one who treats gold as insurance rather than a trade. Gold's identity as a monetary asset, something that holds value, independent of any single government's promises, doesn't require a crisis to stay relevant. It's relevant continuously, and that's exactly why gold investors who held through the correction were holding for reasons that never really changed. Silver's story is more complicated, and here's the key fact that explains almost everything. Roughly 59% of all the silver consumed globally each year goes into industrial use. Solar panels, electric vehicles, semiconductors, data center infrastructure supporting the AI build-out, electronics, medical devices. Silver isn't primarily a monetary metal the way gold is. It's primarily an industrial material that happens to also carry monetary characteristics. And in an environment where rate hike fears were pushing up expectations of slower growth, that industrial identity became a real liability. When the market starts pricing in weaker manufacturing activity, weaker consumer spending, and a cooling economy, industrial demand for silver softens right along with it. You simply cannot separate silver's industrial role from the broader macro environment the way you can with gold. The same rate hike fear that pressures gold through the opportunity cost channel, meaning the appeal of holding a non-yielding asset when interest rates are high, hits silver twice. Once through that same opportunity cost channel, and again through weaker industrial demand. Gold faces one real headwind in that scenario. Silver faces two. So the market did something that, in hindsight, is fairly rational. It kept treating gold as a monetary hedge straight through the correction and the partial recovery, and it started pricing silver more like an industrial commodity, closer to copper or aluminum, whose fortunes are tied directly to how the broader economy is performing. Not because silver's underlying supply story disappeared, it didn't, but because the macro backdrop this year rewarded assets that don't need economic growth to justify holding them, and silver, more than gold, does need that growth. Now bring the FOMC minutes back into this, because this is where the two halves of today's video actually connect. If Wednesday's minutes read as genuinely dovish, meaning the three dissenters come across as having made a case that this week's data has already weakened, and the majority's language around future hikes looks soft, gold's reaction is likely to be fairly direct. Lower rate hike expectations reduce the opportunity cost of holding gold. They tend to pressure the dollar lower. They tend to pull real yields down. Gold could benefit through all three channels at roughly the same time, which is about as clean a catalyst as this metal gets. Silver's reaction to that same dovish read would likely be positive too, but more complicated. Lower rate expectations help silver through the same opportunity cost channel that helps gold. But if the reason the Fed is leaning dovish is that the economy is genuinely slowing, that same weakness that's helping silver's monetary case is simultaneously working against its industrial demand. Silver gets a tailwind and a headwind from the exact same document. The net effect could still be positive, but historically it tends to be smaller and slower to show up than gold's reaction. If instead the minutes read as hawkish, with the dissenters coming across as well supported and the majority's language leaving the door wide open for a hike, gold would likely face renewed pressure, since rate hike fear tends to push the dollar higher and increase the opportunity cost of holding a non-yielding asset. For silver in that same scenario, the picture is generally worse. A hawkish tone implies tighter financial conditions ahead, which historically weighs on industrial activity, and a slowdown in industrial activity hits the demand category that represents more than half of all the silver consumed each year. In a hawkish outcome, silver could face pressure through the rate channel, the dollar channel, and the industrial demand channel all at once, while gold is generally only facing the first two. This is a big part of why silver's recovery from January has lagged so noticeably behind gold's. And it naturally raises the question that a lot of silver investors are sitting with right now. When, if ever, does that gap start to close? Here's what history suggests, with the appropriate caution that past patterns don't guarantee future ones. In prior precious metals cycles, when silver has eventually closed a wide gap with gold, it has often done so faster than the original gap took to open. But that kind of compression has historically required two conditions to line up at roughly the same time. The first is a genuine shift in the Fed's overall narrative, not just a pause, but a real pivot from are they hiking to when are they cutting. When that shift happens, silver's monetary case strengthens at the exact moment lower rates start to support economic activity again, which eases the industrial demand headwind simultaneously. Right now, with a September hike priced at somewhere around 30 to 35%, this first condition is only partially in motion. This week's CPI and PPI data moved in a direction that's consistent with easing, but it isn't confirmation. Wednesday's minutes will either strengthen that case or push back against it. The second condition is a shift in how widely known silver's physical supply story becomes. According to the World Silver Survey 2026, published by the Silver Institute and Metals Focus, the global silver market is on track for its sixth consecutive annual deficit, with the 2026 shortfall estimated at around 46.3 million ounces. Since 2021, the market has drawn down a cumulative total of roughly 762 million ounces from above-ground stockpiles, just to bridge that gap. Registered inventory on the COMEX exchange in New York, meaning the metal actually available for delivery against futures contracts, has fallen sharply from roughly 346 million ounces back in 2020 to somewhere in the neighborhood of 80 million ounces as of this spring. When a structural story like that becomes as widely discussed in the mainstream financial conversation as the central bank gold buying story has become, some analysts believe silver's market classification could shift, moving away from being priced primarily as an industrial commodity and toward being priced as a scarce monetary asset with a genuine supply constraint. That kind of reclassification, when it has happened historically, has tended to happen quickly once it starts. Right now, with the ratio sitting around 67, the market is telling you that neither of these two conditions has fully arrived. The first is edging closer, the second hasn't really started. Both are worth watching closely, and both will be shaped, at least in part, by what comes out of Wednesday's release. So, let's bring this all together. The FOMC minutes dropping this Wednesday, August 19th, are not routine paperwork. They're the detailed record of a debate that took place inside the world's most influential rate-setting body, at a moment when three sitting regional presidents wanted an immediate hike, and the majority held them back by the narrowest kind of margin a 9-3 vote represents. Reading them well means looking past the headline and paying attention to 5 specific things: how the dissenters actually built their case, what exact conditions the majority named as their trigger for future action, how the committee described inflation's character, what, if anything, was said about the labor market before this week's disappointing jobs number existed, and whether anyone in that room introduced the idea of a rate cut before year end. And as you follow that coverage next week, carry the second half of today's video with you too. Gold and silver are not behaving like the same trade right now, even though they peaked on the exact same day for the exact same reasons. They separated because one metal retained its identity as a monetary hedge through the shift in the macro environment, and the other reverted to being priced like an industrial commodity in a period defined by rate, hike fear, and slowing growth signals. The same document that could be a clean, supportive catalyst for gold carries a genuinely more layered set of implications for silver, not because silver's underlying fundamentals are weak, but because its largest source of demand is tied to economic activity in a way gold simply isn't. Gold is really only facing one meaningful risk from the Fed right now. Silver is facing two. But silver also has two specific conditions that could eventually close the gap with gold, and one of them is already tentatively starting to move. Both metals are worth watching next week. They're just answering different questions, and I hope after today you're equipped to tell the difference when the headlines start rolling in on Wednesday afternoon. Before you go, I want to hear from you. Going into these minutes, are you watching gold, silver, or both? And after today's breakdown, has it changed how you're thinking about either one? Drop a comment and let me know. I read every single one, and honestly, they shape a lot of what I decide to cover next. Thank you for spending this time with me today. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in